Your career feels stuck. You're waiting for that perfect opportunity to come along. But here is the truth. Opportunity isn't something you wait for. It's something you build. Welcome to NISM e-learning, where your financial career takes flight. We are NISM's online learning platform. Whether you are starting fresh, switching careers, or sharpening your edge, we are here for you. Quality education, affordable pricing, zero barriers. No matter where you are or when you learn, industry designed courses from securities market veterans with decades of real-world expertise. From foundational financial literacy to specialized expertise, equities, mutual funds, derivatives, compliance, risk, wealth management, and beyond. NISM e-learning course covers securities markets areas comprehensively. This includes topics related to mutual funds, financial planning, SME listing and compliance, forensic investigation, anti-money laundering, and more. Every course is built with leading knowledge partners and academic experts, thoroughly vetted and constantly updated. Your journey starts now. Visit online.nism.ac.in today. Learn at your pace. Learn on your time. NISM e-learning. Build your future.
Okay, good afternoon, everyone. It's 4 o'clock, so let's start. I am Kunj Bansal from NISM. Welcome to this webinar on REIT. Before I talk about the speaker and topic in detail, very briefly, NISM is well known, is a capacity building initiative of SEBI. And one of NISM's objective is the knowledge enhancement of financial market participants. It is with this objective that we keep doing webinars on various topics. Of course, we do a lot of other in-person physical programs also, and certifications, mandatory certifications, I'm sure all of you are well aware, is another key activity that we do. So today's webinar is on the topic of REIT. The full form is Real Estate Investment Trust. This instrument has been emerging as an asset class of interest of late, and is particularly of interest to those people who want to take exposure to real estate as an asset class and in its financial form. So after today's webinar, I am sure all of us should be in a position to know and understand what is REIT, what are its advantages, disadvantages, and should we be looking at this instrument as one of our investment options in the time to come. To tell all of us more about REIT, who better than the industry veteran, Ms. Preeti Chheda, who is already with us, available online. To briefly introduce Preeti to all of you, she is the CFO of K. Raheja Corp Investment Managers, who are managers to Mindspace Business Park REIT. Preeti has been associated with K. Raheja Corp for around 18 years across various roles, including equity and debt fundraising, acquisitions, raising private equity for real estate projects, investor relations, and financial reporting. Before joining K. Raheja, she worked with Marico and Shell Gas and Kane Energy. Preeti is a qualified chartered accountant with over 2.5 decades of work experience. She is also a company secretary as well as a CFA charter holder. Preeti has also passed the Uniform CPA examination from the Colorado State Board of Accountancy, USA. She is also a member of the Hybrid Securities Advisory Committee constituted by SEBI and on the expert committee on REIT and InvITs in the IFSC Gift City. She won the coveted Economic Times Best CFO in Financial Leadership Award 2024 and Business World Best Women CFO Award 2024. Welcome, Preeti. All over to you to address the participants. As a format, Preeti will take us through the presentation for, let's say, about 25-30 minutes, and then we will open the webinar for your questions, which will be answered by Preeti. Over to you.
Right. Kunj, thank you so much for that introduction, and thank you to NISM for having me here. As Kunj rightly said, this is a product which is relatively new, but I would say in the last few years, this is a product which has gained a lot of popularity amongst all investor categories. Of course, over a period, it started with institutional investors showing a lot of interest in the product. And over a period, we have seen that retail participation also has started getting better. Of course, we still have a long way to go to reach numbers like mutual funds have done, but I think we have made a good start. So I'll be spending the next 30 minutes taking you all through various aspects of REITs, and then we can have questions from you, and I shall be very happy to answer them. So without spending any further time, let me start with the basic concepts, and then we can move to how the journey of REITs has been in the country. Could we move to the first slide? Right. I think whenever the topic of REITs comes up, there's a primary question which comes to everyone's mind as to what is the difference between a REIT and an InvIT. Now, if you look at any other jurisdiction globally, there is only a word called REIT. There is nothing like InvITs. Everywhere, whatever be the asset class, whether it is roads or whether it's office or malls or whatever else, internationally, everything is called REIT. Whereas in India, SEBI chose to have two different categories of instruments. One is REITs, which is Real Estate Investment Trust, and the other one is InvIT, which is Infra Investment Trust. Now, what was the need to create two different instruments? Why could we not have combined like it was done globally? Now, the answer to that is India is an economy where infrastructure is of great focus for the government. We need huge amount of infra to be built for our economy to grow and see the growth numbers which the government has envisaged. And therefore, to give that kind of focus to this sector, SEBI decided let us keep both of them separate. And then there is another differentiation that under REITs, only publicly listed REITs are allowed, whereas under InvITs, which is an infra investment trust, both publicly listed and privately listed InvITs are permitted. Now, the reason to do that again is there are a lot of foreign private equity investors who have shown great deal of interest in REITs in India and InvITs in India. And therefore, to attract that kind of global capital in the country in this sector, when I say sector, I mean the entire infrastructure sector, the regulator said that let us keep two instruments different so that we can have more and more money coming into the infra sector. Now, the next question, of course, will be in everyone's mind, what goes into REITs and what goes into InvITs? So the Ministry of Finance has come up with a definition of infra. So there is a list of assets or classes of assets which can actually qualify as infra. So for example, your roads, data centers, warehouses, there are hotels which are in cities with less than 1 million population, water resources, energy, communication, all of those fall in the harmonized list of infra, which Ministry of Finance revises from time to time. And anything which is not infra automatically sits into real estate. Now, there is one more clarification which SEBI recently brought up, where SEBI said that even if it is an infra asset, but if it is a rental, like for example, the easiest example is warehousing. So what happens in warehousing? It is actually an asset which is very similar, say, to an office asset, where the asset developer, say, builds a warehouse and then it is let to the prospective tenants and rental income is received. This is very similar to what we do with offer. Such an asset can also sit in REIT. So it has two options. It can sit in REIT or it can sit in InvIT. So therefore, the fundamental difference is InvIT is for infra, REIT is for real estate. But under infra, if there is an asset which is on a rental model, like say a warehouse, it can also sit into the REIT. So that's essentially the difference between REITs and InvITs and why do we have two different instruments in India. We can move to the next slide. Now, of course, let me explain the structure of a REIT because this is where all confusion comes that what is this product? So now this is a product, to explain in simple language. It is similar to a mutual fund, but it works like an operating entity, which is a normal listed company. So the REIT is constituted as a trust. So, like for example, if you take any other real estate company which is listed, it's a company which is listed. Here it's a trust which is listed. So that is the key difference between how a normal operating company works and a REIT works. But if you look at the overall structure, it is very similar to a mutual fund, where in mutual fund, all of you would have heard about an AMC, which we call an asset management company, which is effectively managing all the schemes. Here you have an investment manager, which is sitting outside the REIT and rendering asset management and investment management services to the REIT. Then you have a trustee. Why do we have a trustee? Because REIT is a trust and therefore it cannot function without a trustee. Therefore, we have an external trustee. In a lot of cases, it is the way the regulation prescribes. Then, of course, you have the beneficiaries, which are nothing but the unit holders. And all the assets which the trust is holding, they are all held through something we call as special purpose vehicles, SPVs. They are nothing but subsidiaries in our common parlance. All of us understand what subsidiaries are. So special purpose vehicles are nothing but subsidiaries of the trust of the REIT, where all the assets are sitting. So if, say, I have a business park in Mumbai, and I have a SPV in which this asset is sitting, and then the SPV is held by the REIT. So therefore, to sum up, the structure is similar to a mutual fund, but it works similar to a normal listed company because it has assets which generate income. Now, what is the key differentiation between a normal listed company and a REIT or an InvIT? The biggest difference is, in a REIT or an InvIT, for it to qualify to be that instrument, at least 80% of the assets or the 80% of the portfolio should be completed and rent generating. So you cannot have too much of under construction or development happening in a REIT. That is restricted only up to 20%. 80% has to be completed and rent generating. That is a key difference. Because it is a portfolio of completed asset, at least 90% of the cash flows, we call that net distributable cash flows, have to be distributed to the unit holders once in half year. Most of the REITs are doing every quarter, but the law requires to be distributed every half year. So these are the two distinguishing differences between a normal listed company and a REIT. One, 80% completed and rent generating, 90% distribution. We can move to the next. Now the question comes, how do I invest in REITs and InvITs? It's very simple. It's exactly the way you invest in a normal stock. So you can just go to your broker website or your broker demat. Once you need to have demat, because all the units of REITs and InvITs are in demat form and they're listed on the domestic stock exchanges. So you can, if you have a demat account, you can just go online and buy these units. And all this while they were hybrid, but now SEBI has classified them as equity for the purpose of mutual fund investment. And therefore, we are hoping that going forward, REITs will see space in indices also. So you can actually have ETFs also, which are investing in these products. And anyone is eligible to invest in these products. You could be a FPI, you can be a mutual fund, insurance, pension, HNIs, family offices, individuals. Everybody can invest. And the lot size is just one unit. So you can actually go and buy one single unit, which could be anywhere between 100 to say 500, depending on what is the price for every REIT. Now, why should anyone even invest in a REIT and InvIT? Why should? Because that's one question everybody asks. I'm better off investing in equity. I'm better off investing, say, in gold or any other form of investment. Why should I even look at REITs and InvITs? So I would say, before I even give the benefits of that, one caveat I would say, we are not one suggesting that REITs and InvITs should be replacing equity or any other form of investment. We are saying that if you have 100 rupees to invest, then let part of that 100 rupees come into this instrument also, and I'll tell you why we are saying so. Now, the first and foremost thing is, all this while we had equity or we had fixed income. Equity, high risk, high return; fixed income, low risk, low return. Now, there was a gap between fixed income and equity. Now, what is the gap? The gap is of an instrument which is giving you the benefits of both equity as well as fixed income. That is a gap which is getting filled by REITs and InvITs, where you get regular income because we distribute every quarter, plus the appreciation happens because Indian economy is growing. So both infrastructure assets will keep growing in terms of their revenue generation, and therefore the distributions also will keep growing. And that's why we say that this is a product which is giving you the benefits of both growth as well as distribution, regular income. So it is sitting somewhere in between equity, and it is sitting somewhere in between fixed income. But because we do not guarantee any returns, therefore it is more in nature of equity than debt. In a fixed income instrument, the coupon is assured. Here, the coupon is not assured. So that's one caveat I want to say. Tomorrow, theoretically, all of us have very large portfolios of 40 million, 50 million, 60 million square feet. But say if one floor of a building, or say one building goes vacant, then what happens effectively is that the rent from that floor or from that building doesn't come. To that extent, I'm not able to distribute. That's why we say that it is more an equity and less a fixed income, but it is giving you the benefit of both. So as I said, as you see on the screen also, 90% of your cash flows need to be distributed. Growth, you are getting liquidity because you can just buy and sell on the exchange any morning. If you wake up and say, okay, I want to liquidate, I need money, you can just go sell on the exchange and get money. The biggest another benefit is today, a lot of us invest in commercial real estate. I'm sure many of us would be having exposure to commercial real estate ourselves physically. Now, when you have a commercial real estate or you're owning a commercial real estate, you need to worry about maintaining that asset. You need to worry about leasing that asset whenever a tenant is walking away. Then you need to worry about realizing the rentals every month. So that's a headache which you are carrying when you are directly investing into physical real estate. Whereas here we have a professional team which is managing huge portfolios. So you don't really need to worry about managing the asset. Plus, instead of focusing on an asset which is, say, in a specific micro market, you now get exposure to pan-India portfolio. So that is a huge diversification which you are achieving for as small an investment as one unit. Governance, as we say, we have a very strict, robust SEBI regulation governing these instruments to protect investors, and therefore, from a governance standpoint also, this instrument is very tight. And as I said, diversification. We can move to next. And I've already spoken about this. You're getting regular income and you are getting growth. So where do you get income from? We are getting income from the rentals, which we get from our assets. And generally, in all the real estate contracts, there is an inbuilt escalation which comes to us every, it can come once in 3 years, which say 15% every 3 years, or we can get 4-5% every year. So there is an inbuilt escalation, and every time, because there is an escalation, inbuilt escalation, obviously the yields also start growing. Besides that, we, as I said, 80% of the portfolio has to be completed. 20% can be development. So in that 20% development, once it is completed, again, that will start generating rentals. We will keep acquiring newer assets. We can redevelop older buildings which are within our portfolio. All of these things actually help grow the investments, grow the value of the investments. And that's why we say that this product is a combination of yield plus growth. We can move to the next slide. Now, how has REIT actually helped, and why is the government as well as our regulator so positive about these instruments? One, within 7-8 years of their existence in India, we have reached a very big scale. I'll talk about it a little later. What we have also done is we have institutionalized both the sectors. We were otherwise historically not the most organized sector, both real estate and infra. By getting REITs, we have actually helped institutionalizing these sectors. Second, for a capital market, you have a newer product which is available, because both infra as well as real estate are actually helping urban development, happening rural connectivity. So they're actually helping the economy both in terms of creating that kind of infra and also economic growth. And of course, needless to say, both are sectors which create huge employment opportunities. So overall, it's helping the government. It is also helping us as from an individual standpoint, and also helping get a different product into the capital market. Go next. Now, this is just a quick snapshot in terms of difference between a normal listed company and a REIT. So if you quickly see, a normal listed company has no obligation to distribute. We need to distribute at least 90%. SEBI also has a restriction on amount we can borrow. So without a credit rating, we cannot borrow more than 25% of our total size of the portfolio. So say the value of our portfolio is 1,000 crore, then we cannot borrow more than 250 crore without credit rating. If you have obtained a credit rating, you can go up to 490 crore, 49%. So that's a big difference. In a listed company, there is no limit to the amount they can borrow. They can even go to 70%. Whereas in this REIT, because it's a moderate risk, moderate return investment instrument, so therefore SEBI has limited the debt that a REIT can have on its balance sheet. Again, because I said it's listed on the stock exchanges, you pay STT. Companies are not registered with SEBI, whereas the REIT is registered with the SEBI. So therefore, the investor protection is much more because there is an oversight from SEBI. Minimum holding by the public is very similar to both. Governance and disclosure, if you look at any of our presentations, you'll realize the amount of disclosures that any REIT or InvIT makes is much more than any normal company because that's the way the SEBI REIT regulation is. Next, please. Now comes the taxation. I think the beauty of this product is, first and foremost, the dividend which you receive from this instrument is tax-free in the hands of any form of investor. So there are three ways in which a REIT distributes income. One is dividend, another is interest. Third is whether you call it amortization of SPV debt or we also commonly say return of capital. So generally, these are the three modes in which we distribute cash flows quarter on quarter. In terms of taxability of each of these items, dividend fully tax-free in your hand. So if you receive dividend, say a normal listed company, you pay tax at the marginal rate. But if you receive dividend from a REIT or an InvIT, you don't have to pay any tax on that. Because under the REIT, under the Income Tax Act, which is governing taxation for REITs and InvITs, as far as the SPVs which are distributing the dividends are in the old tax regime. So there is a new tax regime which is at 25%, which we call as concessional tax regime. And there is old tax regime where we still pay 29 or 34 depending on the turnover. So till the time all our SPVs under the old regime, which means we pay higher tax at the SPV, then the income which we distribute is tax-free in the hands of the unit holders. And today, almost all of us are in the old tax regime. So therefore, whatever we distribute to you in form of dividend is exempt from tax. Interest, if it's coming to you from any of the REIT, that is fully taxed. Amortization of SPV debt, or as I said, return of capital, you need to just reduce that from your cost of acquisition. You don't have to pay any tax immediately. So effectively, what happens when you're reducing from a cost of acquisition, anytime in future, when you sell the unit of the REIT, then you'll end up paying capital gain tax because now your acquisition cost is reduced. So the profit or the capital gain is higher, and therefore you'll end up paying capital gain tax, but that you pay only when you're selling the units. Till the period that you hold the units, you don't pay any tax. So just remember there are three forms: dividend, interest, and return of capital. Dividend tax-free, interest fully taxed, return of capital not taxed when you receive it, you reduce from your cost of acquisition. So it's implied that you pay capital gain when you sell. So that it's not too complicated. And also what we do is at the end of every year, we actually, and in fact every quarter, we give a statement to all our unit holders where we tell you how much you should take as dividend, how much you should attribute to interest, and how much you should attribute to return of capital. So you don't have to really worry how much should I take as dividend also. We will give you everything every quarter. Next, please. This is how REITs have evolved globally. So the first REIT happened in US in 1960. And then, of course, it moved to Asia. In Singapore, because our REIT regulations are actually mirroring the Singapore REIT regulation. They are very close to how Singapore REIT regulations have been drafted. So therefore, we keep talking about Singapore more closely because the regulations are very similar. Overall, across the globe, there are 1,000 REITs and InvITs because globally it's only REIT. And between them, the market cap that they're managing is as much as $2 trillion US. So that's essentially the size of REIT market globally. And some of the very advanced REIT markets globally are US, Japan, Singapore, Australia. So these are the four very big REIT markets globally and very mature also because they've been for a long period. Yeah, let's move. Now, this is an interesting statistic just to say that internationally, how REITs have made inroads into the real estate sector and real estate capital market. So if you see the first bar chart, when you are seeing 98.4, what does that mean? Of all the listed market cap, real estate market cap, which means if you take all the listed companies in the US, which are listed, that's why we are saying listed market cap, 98% of them are REITs. So in US, you don't have a normally listed real estate company. Everything is a REIT. Unlike India, where you have 90% actually as normal listed company and only 10% are REITs today. So the scope is much more for REITs to grow in India. So like you have DLF, you have Macrotech, you have Oberoi, Shobha, etc., etc. They are all normally listed companies and not essentially REITs. So therefore, there is a huge room for REITs to actually grow in India, given how internationally things have moved. Next, please. These are some of the asset classes which you see in US. This is just for you to get a sense of what all could come under REITs. Retail, which is nothing but malls, the largest, residential, healthcare, telecom, industrial, data center, office, lodging, you just name it and everything is there in US. So they are highly popular instruments internationally. Next, please. Now, this is quickly in terms of how the REIT story has evolved in India. In 2014, SEBI came up with the REIT regulation, but obviously we did not have a tax structure which was conducive for them. Globally, REITs have only single level taxation. Single level taxation means what? Tax is levied at one stage. Either it is at the SPV level, or it is at the REIT level, or it is at the unit holder level. It is not levied on the same income again and again. Otherwise, the whole purpose of an income kind of product gets defeated. So therefore, representations were made to Ministry of Finance, and they took a couple of quarters, years to understand and do this. So therefore, in 2016, we got a tax structure for REITs and InvITs. Then the regulatory environment went some changes. And then we had a first REIT, which is Embassy REIT in 2019, followed by Mindspace in 2020, then Brookfield, then Nexus. And very recently, we had Knowledge Realty Park, which many of you will be aware of. They got listed almost, I think, a quarter back. Yeah, next. So this is just how big REITs and InvITs have become in India. Almost REITs and InvITs between themselves are managing almost 9.5 lakh crore of assets. In terms of market cap, it's close to 4 lakh crore. So this is the size which the REITs have garnered in such a short time. Go ahead. This is only specific to REITs. Earlier was REITs plus InvITs. This is only real estate. So even in terms of REITs, it's more than 2 lakh crore of assets under management and almost 1.5 crore of market. And there are almost 175 million square feet of assets, which 5 REITs collectively are managing. Yep, next. These are some of the sectors under InvITs: roads, fiber, telecom, and warehousing, supply chain. These are some of the sectors which are on the InvIT side, which are listed. Roads, of course, are the largest. We have almost 15 road InvITs, followed by the other asset classes. Yeah, next. This is how investor participation has been in these products. So if you see, almost 25,000 crore has come from FPI investors, 30,000 crore has come from mutual funds, 10,000 crore has come from insurance companies, and followed by pension. So this is the kind of investment we have seen from across investors, whether it be foreign or domestic. So that's the kind of investments these products have seen. Yeah. Now, obviously, what will interest you all will be what returns have these instruments given. So if we were to compare ourselves with the other form of investment, so if you say fixed deposit, they'll give you whatever, 6%, 7%. If you're talking about, because we have just about a 6-7 year history, we don't have long. And even if you look at the last 6 years, we've given almost close to 15% return, which is a combination of 6.5% by way of distribution, 8% by way of price appreciation, which is the share unit price of any REIT or InvIT going. So it's a moderate risk instrument, but which has given good returns, which are close to 15%. And if you look at Nifty for a similar period, then Nifty has been about 14. So there's always a myth saying that do these instruments actually give returns? I don't think they give returns, but no, that's not the fact. So far in the last 5 years or 6 years, we've actually given a healthy return. Go next. What is the potential for these instruments? Of course, there's a huge potential. In India, we have almost 800 million square feet of office assets. Almost 400 million of those assets are REITable. When we say REIT means they can REITable, they can come into the REIT. So today, the opportunity is almost double, triple. Same with the case of retail. Retail are malls. Mall also is a 7x opportunity. Yeah. Before I end, there are two concepts which I just want to spend a couple of minutes on. So there is one concept of SM REITs, which are small and medium REITs. All of us know that there were initially what we call as fractional ownership platforms, where the asset managers actually collected, say, 25 lakhs, etc., from every investor, pooled all the money, and then bought some real estate. It could be one floor in a building or a small building, and gave the returns to those investors. So SEBI said that if public money is being accessed by pooled platforms, then even those should come under the umbrella of REITs, or rather can come under the umbrella of REITs and InvITs. So therefore, let us have another category, which is called small and medium REITs. And therefore, they introduced this concept of SM REITs, which is small and medium REITs, in 2024, where if the size of that REIT is between 50 and 500 crore in terms of the asset value, then the asset manager can actually list them as small and medium REITs. They do not qualify under the mainstream REITs, but they can qualify under the small and medium REITs. And then, of course, they are very similar, but because they are small and medium, there are certain more stringent, so to say, obligations which are cast. Like, one, to just give one example, in a normal REIT, up to 20% you are allowed to invest in under construction, whereas in SM REIT they have to have only completed asset, because then that reduces the risk. But this is also one category is invested for investors who want exposure, say, to a specific building or a specific micro market. Then they can look at SM REITs. The conventional REITs have large portfolios which are pan-India, and therefore there is more diversification there, but both have their own set of I would say characteristics depending on what the investor is seeking. Yeah, next. Then there is a concept of self-sponsored REITs, wherein you don't actually have a sponsor. So what do you mean by a sponsor? Sponsor is somebody who has set up the REIT and has contributed assets. Thereafter, generally sponsors don't have too much of a role. But say, for example, if you take the first or maybe the latest Knowledge REIT, that's a platform which is, say, sponsored by Blackstone. You have REITs, Brookfield REIT, which is sponsored by Brookfield. We have Mindspace, which is sponsored by K. Reja, so on and so forth. Now, these are REITs where there is no sponsor. The manager or the professionals themselves manage these kind of REITs. So this is also something which SEBI has put in place, so that tomorrow, if any sponsor wants to exit fully and say the professionals want to take over, then that is also something which is provided in the REIT InvIT regulation. So this is actually talking about maturity of our regulation, where all of these things are thought through at early stages of development of this product, and they are made available so that tomorrow, if these situations come, then the regulation is ready to take care of those situations. I think this is my last slide, so I can stop here and then we can open up for Q&A.
So, ma'am, we have one question from the audience. Is the indexation allowed in REITs?
No. Because now you don't have that, right? Because they've moved to a 12.5.
Okay. So participants can please type in your questions. Ma'am, how much annual returns we can expect from REITs is another question.
Yeah, so as I had put up in my presentation, in the last 6 years of the REITs that they have been in existence, the combined return has been anywhere between 14 to 15%, out of which, say, about 6 odd percent is from distributions, regular distribution, and around 8% plus is from price appreciation. So the price of those REITs have actually moved up. So collectively, on a consolidated basis, almost 14 to 15% is a return which they have got historically.
Okay. There's one participant, Jitendra Agarwal. He's asking, please explain the taxation once. So if briefly you could just put out some points.
Yeah, sure. So there are three ways in which you get income. One, you can get in form of dividend. If you get dividend, it's fully tax-free. You don't have to pay any tax on the dividend which you receive from any REIT or InvIT. So that's number one. The second form in which you can get distributions is by way of interest. Interest is fully taxed in your hand. So depending on which tax bracket you fall in, accordingly, your tax rate will be applied to this form of income. Third manner in which we give distribution is what we call as return of capital. So suppose I give you 2 rupees by way of return of capital, then what you need to do is from your cost of acquisition. So say you bought a unit of a particular REIT at 300 rupees. So you reduce this 2 rupees from your 300. So now your cost of acquisition will become 298. That's all you need to do when you actually receive it. After 5 years, you have sold this unit at say 400 rupees. Now you land up paying tax at 400 minus 298, which is 102 rupees. So effectively, the 2 rupees which we gave to you as return of capital is being taxed at capital gain. So again, and we will let you know every quarter and at the end of every year, we give you a form which is called 64B, which clearly tells you that if I have given you say 10 rupees, how much of this is dividend, how much is interest, and how much is return of capital. Basis that you offer it for your income accordingly. So again, I'm repeating, dividend no tax, interest full tax, and return of capital reduced from your cost of acquisition. It will be taxed only when you sell at capital gain tax.
Okay. Sanjay Chaturvedi asks, MFD is allowed to get an investment in it or need additional empanelment? I think he means to ask, do MFDs need to be impaneled for selling this or not? Or if it is not clear, then I can give
No,
access.
I'm not too sure. I'm not too sure what exactly you mean. I'm not too sure what you mean by MFD.
MFD is mutual fund distributor.
Okay. So today, SEBI has actually not, I would say there's no regulation in place today for any form of distribution incentive for REITs. That's something which we keep discussing with SEBI, and maybe in future we could have something. But today, as we talk, like if you're comparing with mutual fund distribution incentive structure, today REITs don't have that.
Okay. I hope Mr. Sanjay Chaturvedi, it's clear. Else you can again type in, or we can give access to you to speak also. So you let us know. I'll move on to the next question, which is by Vishwas Garade. He asks how to invest in REITs through DMAT. So it is covered
So
in your.
you just invest exactly like the way you invest in shares. If you have a demat account, you just go into your broking platform and just buy. Even if you go to BSE, NSE and just type any REIT's name, it will give you similar information like any other stock.
Okay. Sunil Madan asks, okay, ma'am, one and the same thing. He's asking about taxation, but he is asking in specific context to the new tax regime. So any additional aspect you want to add to your prior
So
tax?
all of us are in the old tax regime, and therefore what we distribute to the unit holders is not taxed. Had we been in the new tax regime, then obviously what you receive from us as dividend would have been taxed. But today, because all of us, our SPVs are in the old tax regime, so the distribution which comes to you, it's not taxable. And if say tomorrow, if any REIT is in a new tax regime, then they will, when they are giving you that information, the quarterly statement, they will tell you that so much of dividend is from old tax regime SPVs, and therefore you have to pay tax. But today, all of us are in the old, so no taxation.
Okay. Jainan Desai is again taxation related question. He's asking, what is the dividend taxation if some of the SPVs are under old regime and some are
If
under
it's
new regime?
Yeah, so if it's coming from an old regime, then no tax. If it's coming from new regime, it is taxed. But as I said, today all the REITs are in the old regime, so no taxation.
Okay. Then some examples of REITs in India and compare it with US REITs.
So some examples of REIT in India are, today we have 5 REITs in India. 4 are office REITs, which is Embassy, Mindspace, Brookfield, and Knowledge Realty. And there is one shopping center REIT, which is called Nexus Select Trust. So there are 5 as compared to 1,000 globally. Between us, we have almost, and there are, just to add, there are almost 23 listed InvITs. So between REITs and InvITs, we are good 28 as of today, as compared to 1,000 globally. Even in terms of the assets, we are just 120 US billion dollars as compared to 2 trillion US dollars. So we are still very, very small as compared to the size that REITs have achieved globally.
Okay. Keshav Murthy asks about the minimum investment limit.
You can
Sai.
just take one
Yes.
unit, 100 rupees, 300, depending on what the market price is.
And Abhijit Satpute again on the taxation part. Nevertheless, I'll read his question if at all any new aspect needs to be added. He says, "Hi Preeti, as you mentioned that we need to pay capital gain tax. So please advise if it will be if we need to pay short term capital or long term capital gains tax."
So if you're holding the REIT units for up to 12 months, then you will go to long term. And if you're selling in less than 12 months, then you'll go to short term. So it's very similar to shares. If you hold for 12 months and more, then long term, less than 12 months, short term.
Okay. Sanjay Chaturvedi asks, investment in foreign REIT also possible, like for instance Singapore or US?
So, if I'm getting the question right, you as an investor, can you invest outside? Then, of course, it depends on what are your limits that you can invest and so on and so forth. Of course, yeah, even as Indians, of course, there are a lot compliances to do. But if you say yes, yes. But if you're saying that can the Indian REITs invest in foreign assets, then today not.
Sachin Mehta asks how to calculate the valuation of a particular REIT.
So I think for REITs, it's very simple because every REIT on a half yearly basis actually gets a valuation done from a registered IBBI registered valuer. And those valuation reports are available on their website and they're also published. So if you want to figure out what is the valuation of the portfolio, you can just go and refer to any presentations which are made on a half yearly basis. Valuation reports are placed on the website, so you have everything handy. To the extent, we also give our NAV per unit every half year. So say we are trading at 100 rupees and our NAV is 110 or 90 as the case may be, you'll get that number also available on our website or on our presentations.
Okay. Vamsi Krishna asks, how can we distribute REITs and through what platform?
So today, as I said, distribution framework or construct is not in place for you to, of course, you can always advise your investors depending on their risk appetite. But if you're asking for a incentive structure, then that's not currently in place. But we are already, discussing, and let's see in future we may come up with something.
Okay. Then Arindam Bhattacharjee says, what are the risk factors for retail investors in REITs?
So the risk is very, I think, in terms of the biggest risk, if you ask me, it is only the business risk because otherwise it's a very, as I said, medium risk, medium return product. And business risk is something which is very common to any business. And even the business risk is reduced to a large extent because 80% of a portfolio is completed and rent generating. So I don't think we'll ever get to a situation where the entire 30 million square feet gets vacated at a time. Even in the worst of situation, which is COVID, our occupancies went from 95 to 85 and they are again getting back to 95. So I'm saying even the worst case situation, it didn't go below 85. So I don't see. So of course, the risk still lies that say a floor got vacated or a building got vacated. But it's not that the entire 40 million square feet or 50 or 60, depending on which REIT has how much, gets vacated. So risk is reduced to that extent. And then, of course, governance risk, those are very common to any business. But because of a very strong governance structure, it's mitigated to a large extent.
One of the anonymous attendees is asking what should be the ideal percentage for allocation in REITs.
I think that's an individual decision depending on how are you allocating between all the asset classes. So I think this will depend on each investor's risk appetite.
And another question is, are any SM REITs launched till now?
Oh, yeah, yeah. You already have, I think, one SM REIT which is already listed, and I think 2, 3 are in pipeline.
Okay. Then another question is again on the nature of what is beneficial. So this is like we are not recommending anything. So I'm just skipping that question. And what is the face value of the REIT is a question by Sharik Faiz.
So there is no concept of face value because this is a trust. It is not a company where you have face value. These are units. These are not shares. So there is nothing like face value. So the trading price is what determines what that value of that unit is.
Okay.
On the market, of course, the value we as I said, we give an NAV. So that NAV is representative of the intrinsic value. Say today, if you were to go and sell all the assets in a private market, then what you realize is actually representative of the intrinsic value, but you're not necessarily are trading at the intrinsic value. It can be above NAV, you can be trading below NAV.
Sanchit asks how to evaluate any particular REIT before investing.
I think 2-3 things which you can look at. One is the portfolio diversification. What are the kind of returns they have given over the last couple of years? You can also look at what is the composition of distribution, how much is dividend, because that decides your taxability also. And then, of course, important as always is who are the sponsors, what's the governance.
Another question by an anonymous attendee is, what are the differences between sectoral fund and REITs
So
from a risk
sectoral funds can,
perspective?
yeah. So sectoral fund can even say, for example, invest in development real estate, whereas REITs are more on the completed operating assets. So from a risk profile, REITs are, as I said, far relatively safer because you have underlying cash flows and long-term contracts. A sectoral fund, for example, it could be a real estate sectoral fund, and they can invest even in under construction development risk assets also. So the risk return profile is very different for both kind of funds.
Okay. Uday Pruthi asks, if we want a source of regular income, can we purchase REITs in place of bonds?
Yeah, so if you heard me at the start of this session, I said REITs are actually giving you the positives of both fixed income, which is bonds, fixed deposits, and so on, and equity where there is growth. So if you're investing in REITs instead of, say, bonds, so you get regular income plus you'll see that income growing also. In a bond, what happens if you're put in, you'll only keep getting the fixed interest. Say if your interest is 8%, I'm just giving an example, you'll keep getting 8% all the time. Whereas in case of a REIT, say you start with 8% yield, then it keeps growing because you're getting two things. One is the yield, plus you are getting the unit price appreciation. So you'll, in terms of what you earn, it'll obviously be more. But as I said, bonds are backed by, I mean, if you say risk, obviously if you're going and putting in a government bond, then it's absolutely risk free. If you're putting in a REIT, it's moderate risk, equity is high risk. So that's how I'll classify.
Another question, Virat Sharma, not very clear, but then I will just read it out. How does the management team's alignment with shareholders manifest in their incentive structures? And what historical evidence shows alignment or misalignment in capital allocation decisions like acquisition versus dispositions?
Okay, so there are two forms of fees which the manager gets. One is for managing the investments and then the managing the portfolio. Today, those fees are anywhere between, I would say, 4 to 6% of the rent, or let me loosely say revenue. And these are all disclosed in the offer document. So anyone investing can go to the offer document or financial results and you'll get it. When it comes to acquisitions and dispositions, the REIT managers do not take any fee. So therefore, there is no, I would say, alignment or misalignment in terms of just adding assets to earn acquisition fee or disposing assets to earn disposition fee. So there's no fee which any REIT manager is charging to any REIT for acquisitions or dispositions.
Prashant asks that, is there a mutual fund which invests specifically in REITs or InvITs?
So far, not, but I hear that mutual funds are already working towards launching specific schemes which are dedicated to REITs and InvITs.
Sandeep Kandhari asks, investment of how much is required, which is answered.
One unit.
Om Prakash Soni says, given the choice in which REIT or InvIT you would love to invest in 5 to 10, we can ignore this question. Arnab Chakrabarti, in which REIT we have risk-free high return, small REITs or normal REITs? Risk-free
So
high
I
return.
think, yeah, so I don't think anything is risk free. It is a level of risk, and as I kept telling, REITs are moderate risk return. So therefore, from a risk profile, whether it is small or it is normal REIT, I would say the risk profile is moderate risk. Returns obviously will vary from REIT to REIT, so you need to look at. But as I've said, the conventional REITs have in the last 5-6 year history that we have given 14-15. SM REITs have just come, so we don't really have the history, but you'll have to watch the space going forward to see what kind of returns they give because the regulation itself came in 2024, so they are very new.
Gokul Kram asks, the question is anything like Form 15G or H, which will help in not deducting TDS for REITs?
Yeah, but that'll be only for the interest which we give. Dividend any which ways is coming tax free. But 15G, 15H, if say any REIT is giving interest, then yes, it helps.
Okay. Shomita Saha asks, how do we get the valuation done quarterly? And what is the CAGR?
No, you don't need to do valuation quarterly yourself. Valuation is done by the REITs themselves and they are actually made public. So if you go, and this is done on a half yearly basis. So if you go and see any of our website for September and March, the valuation of entire portfolio is done and it is made public. So you don't need to do anything yourself. It's already available.
Most of the questions are repetitive, so I'm skipping it. One person is asking, is it safe to say, Sachin Mehta, is it safe to say that 8 to 10% returns are there, dividend plus capital gains together in this product?
So, Mr. Mehta, as we said, in the last 6 years, on an average, REITs have given, this is an average of all REITs, around out of which 6 was in, and about 8 what was in form of capital appreciation. So overall returns have been between 14 and 15 historically.
Then the question is again a repetition, but still, if people are asking, where can one invest in REITs is okay. Is it through a broker on the NSE or the BSE is what they're meaning to ask.
It's actually just like your investment in shares. You can just go to any broker platform and buy them if you have a demat.
Okay. Viren Shah asks, is there any sovereign guarantee by government or any other safety?
No. That's why I told at the start that this is more drifted towards equity because we don't guarantee any returns. They are safe products because they have underlying contracts. 80% has to be completed portfolio. So those are inherent attributes of a REIT. But if you are saying like government guarantees some portion of fixed deposit, say a bank goes bust, no, there's no such guarantee.
Fakri Alam says, how liquid are REITs when traded on stock exchanges?
Yeah, so because the very fact that they are traded on stock exchanges, you can just go buy, sell whenever you wish to. And that's exactly the beauty of REITs because on one hand, they are giving you exposure to real estate or infra, and at the same time, you have a liquid instrument in hand which you can buy and sell anytime.
Ma'am, again a repetition, but since just for clarification, we can again reiterate some answers. Which REITs can be traded in Demat account, Embassy, Mindspace,
All
etc.?
of them, all of them.
And Jayendra Mehta asks, mutual fund has expense ratio 1.5%. Why is expense ratio in REITs around 4 to 6%?
So I think there's a difference. 4 to 6% is of the rent. It is not of the AUM or the size. So therefore, 4 to 5, and just want to say that we are the lowest across the globe. The fee structure which the REITs have in India is the lowest as compared to any other country in the world in terms of the fee. So 4 to 6% is on the rental income, it's not on the AUM.
Arnab Chakrabarti asks, okay, no recommendations here, so I'm skipping that question. REITs and InvITs, ma'am, if you could please tell the difference once again, is what Alpesh Patel is requesting.
Yeah, so REITs and InvITs work the same way. They are no different in terms of the regulation. The only difference is the asset class. REITs put in real estate, say office, it could be, as I said, shopping centers, it could be hotels, it could be warehousing. Whereas InvITs put in infra assets, which is say roads, the roads, highways which you go to. It could be metro, it could be renewable energy, it could be transmission lines. So all infra assets versus real estate, that's the main difference. Otherwise, in terms of the structure of the product, it's similar.
Okay. Are Indian REITs becoming a viable option for long term wealth creation or primarily an income generating instrument, is what Yashika asks.
The very fact that it's given 14-15% return itself, I think, speaks for from the wealth creation perspective. Because if this is an instrument which is giving you moderate risk, which means some amount of safety as compared to pure play equity, then it is actually giving you returns with, I would say, moderate risk. And therefore, even from a wealth creation perspective, if you look at the long-term returns of equity, they'll be similar in 1-2% plus minus, which is okay. But despite this being a relatively safer product, it has still at least so far given similar returns.
And Vishal Arora
And
asks,
just to add, Rasmit, just one more thing.
yeah.
I think one other thing to remember is real estate is an appreciating asset class. So we all of us know what if even if you have bought your own residential houses, just ask yourself 20 years back what was the price of that residential flat which you bought. And today, if you sell, what have you, what are you getting? So in India, any which ways real estate is appreciating class, and therefore that will translate in the value of the units also.
Vishal Arora asks, what is the expense ratio as a percentage of AUM in REITs?
Of the AUM, so it will be less than 1%, not even less, it'll be less than 0.5%.
Okay.
It's like very minimalistic.
So, ma'am, we are done with all the questions. Uh, I would just like to conclude this session by thanking you. And it was in a very beautiful manner that you had demystified this concept of REITs. And we'll further look forward to having more sessions on this InvITs, REITs, since we see a lot of audiences interested in REITs as an emerging product and to understand better
Sure.
about it. Thank you so
Thank
much.
you so much for patiently hearing me. Thank you, everyone.
Thank you, participants, too.